How to know if a stock is truly undervalued. This is what we are going to talk about in this video. Sometimes stocks drop a lot, but they are not cheap because fundamentals have deteriorated and the drop is warranted. How do you know if this is a good opportunity or just a value trap? This is what we are going to talk about with clear examples today. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year because I avoided falling knives. This is really important. So how do you know if this is a value trap or if you have a golden opportunity in front of you? The first point I want to make is a price drop doesn't mean it's a good deal. Most investors confuse cheap with undervalued. Sometimes you have the basic mistake of thinking if a stock price is low, meaning like $8, it's cheap. First basic mistake, it has no value. The figure you see, whether it's a $5 stock price or $5,000 stock price, means nothing. You have stocks like AutoZone, for example, with a stock price of $4,000. Okay, it doesn't mean that the stock is expensive, and at the same time, you have stocks that are worth a penny. That doesn't mean that they are cheap. First point I want to say before moving forward. Second point is sometimes stocks drop, and that doesn't mean that it's cheap at all. You have, let me draw a little bit. Sometimes you have stocks that will, let me put two categories here. Stocks that will drop meaningfully because the fundamentals are following. If the fundamentals are following the stock price, it means the thesis is broken and this is warranted, and the PE ratio will not evolve over that. For example, if during the before the drop the PE ratio was 30 here, after the drop the PE ratio will be 30 because the stock price is moving in the same direction as the earnings. The blue line is the earnings growth. Okay. Another category is the opportunity. You have a stock price that drops and you have fundamentals that are stable or growing again for some reason. That means before the drop you had a PE ratio of 30, and after the drop it goes back to 20, let's say 20. These two examples are the only thing you need to know. Differentiating the two categories is very hard. Either you have a broken business or you have a broken stock. Different things. You have a broken business, so valuation is warranted, so a stock price doesn't mean that it's cheap. Or you have a broken stock. BS, BS doesn't mean what you think. Broken stock. This is the only category you need to focus on to outperform the market. I've been doing this for more than 8 years and generating 25% per year, focusing on these opportunities. So you will not have a 100% hit rate. I guarantee that you will have failures. But if you only focus on the broken stock parameters, you will love it. You will love it. Meta Platforms was exactly in this situation. Earnings flatlined and the stock price tanked in 2022. Netflix had the same thing. So we'll see how it evolves over time. But right now, today, I see opportunities with broken stocks. I see opportunities that are in this setup. Okay? Ask these 3 questions before every purchase. 1, why is it cheap? 2, what is the real value? And 3, what am I missing? This is the third question is inspired from Lilu. Always ask, what are you missing? This is a very important question to ask. So why is it cheap? Why do you have the stock price that is dropping? For some reason it has followed. Is it cheap or not? What are the reasons? Please highlight 3 to 5 key risks why the stock is dropping. if this is cheap. For some reason, is it a temporary issue, or do you have a real threat? You have a real disruption in this industry? Do you have real competitive pressures? Is the business cyclical? All these kind of questions you have to ask to answer the first one. Why is it cheap? Secondly, what is the real value? Again, if you really know what you're doing and you're doing the real research, you should know the value of your businesses. Not in terms of dollars, like $4,000 for AutoZone or 1 cent. No. What is the market cap? If you could buy the whole business, what would be your target price? Pretty important. Pretty important to see a business as a whole. And based on this formula, on the per share metric, you can calculate the intrinsic value of a company. Third point, what are you missing? What are the elements you wish you had to have a more complete view? And then I think I have an example, real life example, TPL, the stock everyone loves, but no one understands the risks. TPL, in case you don't know, is Texas Pacific Land. It's a company in the US that owns 900,000 acres of lands in Texas. And this is a company that is quite old, 1888. And under these lands, on these lands, you have oil. So all majors come to drill oil on their lands. To some extent, TPL doesn't need a lot of efficiency. They don't need employees. This is a royalty business that is growing rapidly, growing a lot. And if you had invested in TPL a few decades ago, you would have been very rich. Okay, very, very, very rich. We are talking about this kind of life-changing money. I was invested in TPL. I invested in TPL in 2020 when nobody wanted to invest in TPL. And I sold here in late 2024 at the absolute top. It was almost a 10x. A very simple idea, very simple process. Keep it stupid, keep it simple. You don't need to be a genius. You just find one TPL and this is it. Now the stock has dropped significantly. Below high, you see 47%, which means that the stock is getting cut in half, and you start to see some YouTube videos saying, the stock is cheap now, invest now. I disagree. The stock is still expensive. If you look at the valuation, you still have a forward PE ratio of 37, 38. When I bought, it was 17. Okay? We are not talking about the same kind of opportunities. Some people like it at these levels, and they are very optimistic to think that this business can grow 25% per year. The TPL is a business that can grow on a relative basis, let's say 10% per year, 15% per year. It would be very difficult to have more than this. And if you see a business that is growing 10% per year, paying a PE ratio of 38 is egregiously overvalued. So a stock price drops doesn't mean the stock is cheap. So even though the cash balance is great, they generate a lot of cash flows, they are growing, things are in the right direction, yes, but the stock is just too expensive. The stock is dropping, getting cut in half. It's not cheap enough. You have to drop more than this. And I think I will be a buyer of TPL below 700, 800. You need to drop more than this to a more reasonable valuation. People that are buying right now are taking a huge risk. Maybe this is the bottom, maybe not, but I am not a buyer. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. So yes, you have a lot of people loving TPL right now. People are discovering the company, saying, oh, look at the sky-high margins. Yeah, I mean, I've been following the business for 6 years now. So yeah, I know the quality of the asset. I know the quality of the lens. And by the way, you have the same people that think that they can acquire new lens. I would suggest these people to look at the track record of the company, to track record of the management team. But you will see. No one understands the risks. Actually, if you want a few risks for TPL, I would say to check the management team, the governance, what happened in 2023. Actually, in 2023, the stock dropped. Look at this. Stock dropped from 900 to 400. So cut in half. because of a governance fight. The biggest shareholder, Horizon Kinetics, attacked the management team that attacked Horizon Kinetics for some seats in the boards of directors, some decisions from the management team that were completely stupid. I'm not afraid to say it, completely stupid. They wanted to dilute the shareholders, which is not the purpose of TPL. TPL is a cash cow that has a history of doing buybacks. And now they completely stopped buybacks in 2017. They are doing dividends instead, and they want to dilute shareholders to diversify the operations. I don't like this at all. You have key risks when it comes to the management team for TPL, but people don't care right now. People just see a stock price that has gone up a lot and down a lot, and why not the rebound? I see these people as traders, not investors. Please consider the risk for, I'm talking about TPL, but you have plenty of other examples here. Stocks that have fallen and people still don't understand the business models. We've talked about TPL inside the coaching program with clients, about the situation and the complete picture. It's always good to be in a community of people that are very smart, and everybody in the coaching program is very smart. So we discuss on a very serious level stocks, companies, like real businesses, not stocks, lottery tickets. No, real businesses. How do you outperform the market being a business owner? This is the solution I have found, and I teach people how to do this. How can you make 20% per year investing in businesses, not stocks, businesses. Stocks are partial ownership of businesses, okay? Next point, you don't need complex models, just the right filters. Actually, you maybe need to know 3 or 5 things about the company to buy. Very few people understand this. You don't need to know everything about the company. You don't need to know all the incentives, all the competitors, sometimes you will get a crazy opportunity at a crazy valuation, and you need to be quick, you need to be fast, you need to have a simple framework that will allow you to be nimble and fast. This is how I invested in TPL, by the way. You need a very simple business model. Complexity will cause you, analysis paralysis. And actually, plenty of people right now are having analysis paralysis. Actually, some of my best clients, when we had our first call, were in this state. They just have too much information, too much noise. You don't know what to focus on. What if you can just summarize this in 5 points? And this is the reason I have generated 25% per year. 5 key points that are important that will allow you to make 20% per year. You just need the right filters. And if you don't know the right filters, you are literally missing out on thousands and thousands and thousands of dollars, okay? The solution is to learn to analyze like a business owner, not a speculator. If you are a business owner and not a trader, you will outperform the market. You are much more likely to beat the market, generate 20-25% per year. And this is what I teach to my clients, how to do it, how to outperform the market. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.